So most small account traders actually blow up on SPY or ES, but not because of bad calls, but because they don't really understand how the products work. They track the same S&P 500, but one is slow and safe and the other is sort of fast, leveraged and dangerous if you're not ready. By the end of the video, you know exactly which one to trade and which one makes sense for a small account. So what is the SPY and ES? Let's do a quick refresher so we're on the same page. So the SPY is an ETF, which stands for Exchange Traded Fund, and that tracks the S&P 500 one-to-one. So you can buy and sell it on any stock brokerage account. It's super liquid, and S&P options are amongst some of the most highly traded in the world. It's great for investing, swing trading, option trading, and day trading. So the ES futures, the E-mini S&P 500, also tracks the index, but they're traded on the CME. They're leveraged, and they trade nearly 24 hours a day. So that's the reason why futures desks, hedge funds, and active intraday traders, more experienced traders, trade the ES rather than the SPY. So at the surface, both of them track the S&P, but the way they trade couldn't be more different. So if we just zoom out for a second and just have a look at the historical context. So the very first S&P 500 ETF was actually launched back in 1993, which makes it 30 years old. And it was actually the very first ETF of its kind. And now today it's the single most traded ETF in the world with a daily volume in the billions, multi-billions. So why did it take off? Because it essentially gave retail investors and funds a simple way to track the S&P 500 without buying all of the 500 stocks at once. So it was designed for accessibility and investing purposes. Now if we look at the ES futures, which was launched in 1997, the CME built them specifically for traders and institutions. So instead of buying the index for hundreds and hundreds of $1,000s, you could essentially just trade a futures contract with a smaller margin deposit, which meant leverage, speed, and nearly 24-hour access. So here's the key. SPY's DNA is sort of built for investors and long-term holders, and ES's DNA is built for traders who need size, movement, hedging capabilities, or need to react to instant global events. So even though they both track the same index, the origin story explains why they sort of behave differently. Right, so let's start with the capital. So one SPY share actually costs $638 at the time of recording this video. And many brokers for SPY, they actually offer fractional shares. So you could literally start trading SPY with less than $100. But for the ES futures, one contract actually represents 320,000 of notional S&P exposure. So 1 point for the ES is worth $50. So essentially a 20-point move against you would be a $1,000 loss. And a typical day is essentially 40 to 80 points, meaning there's 2 to 4k swings in either direction. Also there's margin requirements, about 12,000 to hold overnight. And some brokers let you day trade intraday margin at 500 to 2,000, but that's extremely risky. So the winner for small accounts in this section, SPY, hands down. The SPY lets you trade small size, and the ES essentially has high requirements for traders trying to get into the futures game. So with regards to flexibility and trading hours, the S&P trades 9:30 AM to 4 PM Eastern, normal market hours, with pre-market and after hours volume thinner and spreads a lot wider. The ES, well, it trades nearly 23 hours a day, Sunday night through to Friday afternoon. If CPI drops at 8:30 AM, ES moves instantly. If Powell speaks after the close, the ES moves. So the flexibility is huge if you trade macro. But ask yourself, do you really want to be glued to the screen at 3 AM in the morning? Understanding leverage and risk. So one ES contract, like we said previously, $50 per point. 10 points, $500. 40 points, $2,000. And that's essentially how small accounts disappear. But with the SPY, it's much slower. A 10-point move in the S&P equals to about a 1-point move in the SPY. So that same trade would have cost $80 instead of $8,000. So leverage sort of cuts both ways. ES gives you power and speed. SPY gives you training wheels and time to learn if you're a beginner to the trading world. So let me just pull both of these up on the trading platform so you can see SPY and ES side by side. So here's my trading platform, and as you can see we have SPY on the left hand side and we have ES on the right hand side. And as you can see from the price action and what they're displaying, both charts look very similar. And that's because both of them do track the S&P 500. But there's some slight differences that I just want to show you first of all. The first one's here. You can see when the ES gapped down from after hours to pre-market, it was actually shown directly on the ES chart because ES trades nearly 24 hours, 23 hours a day. However, the SPY actually closes during that time period, and that's one of the main differences between both of the tickers. If you need that flexibility of trading outside of market hours, then ES would make sense, would be perfect for you. If not, if you like trading in market hours, then SPY could be a better fit. So taxes and execution. So SPY is actually taxed normally. Short term if you hold under a year, and long term if it's over 1 year. But the ES futures, they actually qualify for 60-40 tax treatment in the US. So that means 60% of gains taxed as long term, 40% as short term, even if you held the trade for minutes. So execution also differs. So the ES trades on a centralized futures exchange, which has very, very fast fills. But the SPY trades in the fragmented equity market, which can sometimes mean slower or less clean fills, essentially. Right, so let's talk about beginner pitfalls. Why do beginner traders struggle when trading these products? So here are the biggest mistakes that I see beginner traders do when they're trading these products. Number one, they think ES is free money just because of the leverage. So like we said, one ES contract moves $50 per point. A 20-point swing would mean $1,000. And that would just instantly wipe out a new beginner trader into the market. Somebody that doesn't understand leverage. Number two, holding ES overnight with no stop loss. Due to ES trading nearly 24 hours, news from Asia and Europe can move the market 30-40 points in either direction while you're asleep. And that's just essentially a margin call waiting to happen. Number three, trading SPY options without realizing the theta decay. So this ties into more of how options are traded. So if you don't know how options are traded, I'll make a separate video explaining everything about options. But just for now, understand that even if you're on the right side, if you're in the right direction, the time decay, the theta, can kill the trade and leave you in the red. And finally, if you're switching between each of the products every day without a plan, without a structure, and without a vision, you're essentially going to blow up your account like most retail traders do. So avoid these traps and you'll be ahead of the majority of retail traders. So the bottom line, which one's better for small accounts? SPY, if you're under $10,000, you're learning how to trade the S&P. If you want to swing trade or trade options, or if you prefer limited risk, the SPY will be perfect for you. Or the ES, if you've got margin and risk management skills, if you're a more experienced trader, you want to scalp or day trade volatility, or you need overnight access to macro events, then the ES would make more sense. Both are powerful, but the worst mistake is trading the wrong product for your account size. So the SPY is the safer option, the ES is the more advanced tool.